Hello and good morning, listeners. Someone rightly mentioned it's the love in the times of inflation and uncertainty this year. And as we await another inflation data, uh, as just one released yesterday, folks, this is Almus Market Mornings with Shikhar Garg. And let's look what do we have on our plates for this Valentine's. Indian CPI, as JK was accurate enough in identifying, was a surprise on the higher side at 6.52 versus an expected numbers of 5.9%. US inflation data is expected today, and majorly markets are awaiting this number to take their course of action. So that's one bit of an update. But before that, there's another one. The Japanese government nominated Kazuo Ueda as the next governor for Japanese central bank, who has basically renewed the expectations for a tighter monetary policy this year. So, JK, what's your take? I mean, there's so much to cover. Even oil has also become a quite active market again. So, what do you have for us? What should we be looking for?
Yeah, let's begin with looking at what came out of the Indian inflation numbers. It was way beyond anybody's expectation and coming at 6.52% versus 5.72% in December, and also 5.9% that was expected by many. It was, I could say, a shocker. And the food inflation was the culprit, coming at 5.94% versus 4.19% in December. And just to give you a perspective, in FY23, inflation has averaged 6.8%. That is 200 BPs higher than the 5-year average witnessed between 17 and 22. So India had a small, brief period of moderating inflation for 2 months, and now suddenly we are back up above 6%, which should not be a comfort for the central bank, which is now once again staring at the numbers coming above its mandated limit of 6%. And what it means is that RBI is not going to be done with just one more rate hike. There can be more rate hikes than one. That is what I feel. And what is the implication for the rupee? Of course, is that the higher nominal interest going forward would make keep the rupee a bit stable, and also RBI possibly will keep selling dollars at higher levels to ensure that imported inflation does not add to the already high inflation due to weak rupee. We'll also have WPI inflation numbers released at noon today, with expectations once again coming down 4.54% from 4.95%. Just to remember that in May 22 we were above 16%, but really the massive fall in the WPI numbers have really made no difference to the overall retail inflation and the policy expectations. In rupee terms, yesterday we had a follow through buying in the dollar up to 80 to 75, but not surprisingly met strong selling from state-run banks. And now the higher inflation obviously adds to bonds getting sold off and yields going higher. And higher yield means that the rupee might be somewhat supported, but it all down. It's down to the flows part of the market. So if we continue to see outflows due to stock market, that can be negative for the rupee. Also, we will have the trade numbers tomorrow possibly, and that keep an eye on that number for the direction of the rupee. And on to the other inflation number that is expected in US. Expectation is for further moderation in the headline from 6.5 to 6.3. But what Fed cares more about are the core numbers. Here again, the expectations are for a break in the trend, with inflation excluding energy and food prices to come down faster than the headline number. So its core CPI expected to drop to 5.4% from 5.7%. The only concern could be if expectations are matched by the results, the month-on-month number is expected to actually inch up. So core number coming down would be good news for the Fed, and continue to support a general move in favor of risk that was damaged by surprise job numbers on February 3rd. Naturally, if inflation were to be lower than expected, it would further the outlook for the Fed not to hike as fast, and we can see probably a weaker dollar going forward But I think the market will also look at more numbers down the week, retail sales number and industrial production. Important to see how the economy is doing. Now, the markets seem to be discounting a very good number with major indices in the US closing more than 1% higher. Europe recovered some of its recent big losses, and the global composite index rose by 0.8%, all reflecting optimism. And of course, maybe they are discounting too much because we need to look at the retail sales and the industrial production number as well. Yields moved in a much smaller range yesterday. 10-year was down, marginally at 3.70%, and the 2-year was down at 4.52%. Now, dollar retraced some of its big gains of recent sessions. Obviously, some squaring up by traders ahead of big numbers. The dollar index hit a good resistance on the technical charts at 103.85 after having gained more than 3% from the low of 100.80. Exception was, of course, yen, which was sold off in a pro-risk environment, and also many market participants thinking that the next BOJ chief might not necessarily signal an imminent change in the course from the negative interest rate policy. On the European side, there was some good news because the European Commission forecast the economy to grow more than previously forecast this year, and it would avoid a recession, which was earlier forecast, with inflation also expected to ease with gas prices falling. The economy is expected to expand by 0.9% instead of 0.3% that was forecast earlier. So that also has supported the euro to bounce from 1.0670, where it has found support a couple of times, and that indirectly brought the dollar index down as well. In the meantime, European officials continue with their conflicting statements on policy, which is typical of them. After an extremely hawkish tone from Schnabel over the weekend that ECB may raise rates by 0.5% for at least another 2 meetings, council member Mr. Visco, who is also Bank of Italy's governor, said ECB must avoid pushing real rates too high, given the level of private and public debt in the euro area. Finally, as Shikhar, you said, Ueda has been nominated finally, officially, as the Japanese, central bank governor. But this market has mellowed down its reactions, thinking that he would likely not rush to overall the ultra loose monetary policy, and will instead let the economic data guide in the exit timing. So on the whole, we are now in an atmosphere of looking at more inflation numbers. Tomorrow we will have even the UK inflation number. So a lot to consider before we really take the next move in the dollar. Thank you.
Interesting, JK, and that's quite good. I mean, folks, I just put a concerning factor first, the upward trajectory of inflation. If we are beginning again, then it may not be a comforting enough factor for our central bank, which further raises the increases the focus of market participants on more than one rate hike by RBI. Now, this needs to be seen over the course of period, but it is also the inflation from the US which will set some bit of a course of action for a lot many central banks across, which we are expecting today. Now, if there is some bit of drop as it is being expected by the markets on the US core CPI, then yes, it's a good news for the Fed, and it basically would be signaling the market participants about the possible pause being imminent in the rate hike regime. But on the other hand, as we have been observing, it was a period of, or rather, I should say, there were days of weaker euro, but we have seen some bit of strength coming back on the revision of GDP and inflation numbers for this year. So it is heavily driven by a lot of data updates as well as geopolitics and the rumors or the expected anticipated numbers. So folks, it's a good uncertain period, and what and we should not rather be missing out on Japanese economy if we talk about uncertainty. So Ueda, after being nominated, may not rush to guide the monetary policy, but it needs to be seen whether he will be going aggressive, or whether what stance will he be taking when it comes to tightening the monetary policy. That's it for today, folks. We shall come back again tomorrow with another round of update. Thank you so much for listening.